Hi, I'm Craig Porter, President of Backer Wealth Management Inc. and Portfolio Manager for the Maple Leaf Group of Funds Flow Through Limited Partnerships. For the last 25 years of my career, I've been strictly looking at natural resource portfolios in the Canadian marketplace and the global marketplace, with experience as a senior portfolio manager at both Altamira Investment Services and Front Street Capital Limited. While I was at Front Street, I went out and marketed, raised, and managed over $900 million worth of flow-through product, making me one of the more seasoned and experienced managers in the flow-through sector in Canada. Yeah, we're quite positive on the natural resource sector. When you look at it, it's an undercapitalized sector where not a lot of money has been spent building new mines, exploring for new deposits. And you're finding that a lot of the old mines are tired and running out of production right now. So prices should react quite positively. A number of the stocks themselves, although commodities have started to move in things like oil, the stocks themselves, the equities, have not risen in sympathy with the rising commodity prices. And we feel that should be changing over the next couple of years. Hi, we think it's a good time to be investing in the oil and gas sector, particularly in Canada. Valuations of equities have been washed out over the past 2-3 years, but in a strange case, the price of oil and gas, or oil in particular, has been moving up. It's doubled over the last year. We feel that there are great opportunities in Canada for companies who can still produce light oil. Canada gets a bit of a knock for producing heavy oil, but there are many opportunities out there of light oil companies who are very profitable right now and doing quite well in this sector right now, today. Much like oil and gas, mining has not been a sector where a lot of capital has been spent. Major companies like BHP and Rio Tinto over the past decade have bought companies that have consolidated and have spent the last decade optimizing mines, getting costs down. While the companies are better, there hasn't been a lot of new production come on. And we think that a number of the companies that will be investing in the flow-through sector will be candidates for companies looking to replace reserves over the next few years. Well, Quebec's a little different than some of the other provinces. The government there is very receptive to mining. They're pro-mining, they put incentives into the sector, and Quebec has a strong history of gold production. A lot of the areas around Rouyn-Noranda, Val-d'Or, Malartic, there's a lot of gold mines. And again, I think there's going to be a period of consolidation here where a number of large gold companies looking to replace reserves start to pick away at some of these juniors. They're going to buy them to increase their reserves as they are depleting assets at the moment. For the two portfolios, they're a little different. The national class will be about 40 to 45% energy. There's a lot of great companies in Western Canada doing work that we think have cheap valuations at current time. On the mining side, for the balance of the 50 to 55% of the portfolio, typically we'll look for 20 to 25% gold, 20 to 25% base metals, and then the balance will be a mixture of things such as uranium or some of the materials that go into the battery cars like lithium, cobalt. There'll be a broader mix. In Quebec, though, as I mentioned earlier, the government very much supports the gold industry, and gold will be about 50% of the portfolio. Strong industry there. The balance will put about 20% in the energy sector. That would be based outside of Quebec, but it's more for diversification in the portfolio, so you're not strictly dealing with a mining portfolio. The remaining 20 to 30% of the portfolio will be a mix between base metals, uranium companies, bulk commodities like iron ore, and some of the battery metals, as I mentioned earlier.